Next, how do hard money loans work? Now, hard money is typically what we use to describe short-term interest-only loans for investment-grade properties. I'll say that again. Short-term interest-only loans for investment properties. So this isn't a loan that you're going to be keeping for the next 30 years or 15 years, really not even the next 2 or 3 years. Ideally, you're borrowing this money for a short period of time, you're picking up a property, you're creating forced appreciation by making repairs to it, improvements, maybe adding on square footage to a property if it's in the neighborhood where new construction is 3 stories and all the existing construction is 2 stories. For your property to comp out favorably with the new properties, you have to add more square footage, right? So when you're getting this money, you want to use it quickly and get out of there, right? Pay the lender off, go on about your business. Where people get into trouble is when they don't have the systems in place to manage that process and they spend more time with those loans than they need to. So that's why they call it hard money, because the terms are going to be more aggressive than they would be if you were getting, say for example, owner-occupied loan, long-term conventional financing, right? So a hard money loan typically is structured like this. It's anywhere from a 6 to maybe 18-month term. The payments are either interest only that you're making on a monthly basis, or they accrue interest only, and then when you pay off the loan, the proceeds of the sale are going to pay off, you know, the interest payments, your principal amount that you owe as a balloon payment at the end of the term, and whatever other costs are associated with the loan. All right? Also, the funders that are doing these types of loans typically are not banks. You cannot go to Wells Fargo and say, hey, I got a great 65% rule deal. You want to fund it? They're going to say, we don't know what the heck you're talking about, ma'am. So when you are getting hard money loans, the funders are typically going to be either wholesale funders that have access to capital because they have a pool of investors. There's some hedge funds that operate hard money lenders. There's also private individuals that lend their own money. Or you'll see a group of private individuals that will pool their funds because it's like, hey, I got $500,000, you got $1 million, she's got $500,000. We're going to put all that money together and lend it out. And so you're getting a return on your investment as the lender in that situation. And then in you as the borrower, you're getting that money, using it for what you need to do, and then getting out of there and you're paying back the investment. Okay? What are the loan costs, right? If I'm taking out one of these loans, I need to know what it's going to cost me. If you're getting a hard money loan in this market, in this day and age, you're typically looking at 3 to 4% upfront interest. Now, these points may be paid at closing, or depending on the deal, whether or not there's enough equity in it on the upside for the back end because you found a really good deal, maybe you'll pay that off when the loan's paid off. But 3 to 4% is pretty standard in this market. And you know, if you go to other parts of the country, money's actually cheaper because we're talking about bigger dollar amounts. So for example, in California, when I do loans out there, we maybe only charge 2 points. You know, depending on the investor, we may even charge a little bit less than that to be competitive, to maybe take them from somebody else. But in this market, typically 3 to 4% is your upfront cost. Now, the interest that accrues on a monthly basis, that's going to be anywhere from literally in this market, 6, 7, all the way up to about 12, 13, 14% is probably the top of the market that I've seen. I don't necessarily do any loans at 14%, but I'm also not doing any loans at 6%. We're kind of like in the middle. If you're doing a loan and somebody's offering you terms outside of that, I don't want to say that they're a liar, but you should possibly be skeptical. You know, somebody says, hey, I got a hard money loan, I give it to you for 4%. I actually had a guy reach out to me on Instagram and say that's what he was doing. He was doing hard money loans at 4%. I was like, wow, that's outstanding because I do conventional loans and I'm not making many loans at 4%. So I'm interested, let's go. And then, you know, when he came back around, he goes, oh, well, there's a $21,000 down payment that's refundable after the loan is paid off, but you have to pay that. This isn't like an actual down payment. This is just like a lending fee. And I was like, $21,000 is a good amount of money. I'm paying this up front for what? It's like an IOU. So usually there's a catch when you hear stuff outside of that range. So everybody has that. 3 to 4% up front. Realistically, especially if you're a new investor, I'd say maybe 8 to 12% on a monthly basis, whether those payments are being made monthly or the interest is accruing and it needs to be paid off when the loan's paid off.